Hey,
Here we are again. What's up, Mr. Mark?
what's up, Adam?
How we doing?
Oh, dude, really good. Thank you for asking.
Happy Monday.
Is it Monday?
It could be Sunday, Saturday,
Don't know.
Friday.
Yeah, happy day to you, bud.
Yeah.
What's your plans today?
Well, today gonna chat with you on camera and then fly home.
Thank God. Yeah, about time.
Yeah.
Thank you.
It's been a good day, exciting day. Today, we're gonna talk about a fund structure versus a syndicate structure.
Yes, sir.
So, lead us off, my friend.
Yes, sir. So they're oftentimes confused for the same thing. And to be honest, when we first were looking into fund syndications, we didn't know the difference either.
Yeah, just sort of use the name synonymously.
Yeah. So after many tens of thousands of dollars later and setting up our own fund, we now know the difference between the two, which you would hope so after you spent lots and lots and lots of money on it. But
I don't know if it took us that long to figure it out. I mean, we recognized it by the deal structure. That's why we chose the deal structure.
yeah,
So,
but the reason why you would do a syndicate versus a fund, and really what the purpose of, even though we kind of knew up front, now that we set up the fund, you start to really realize, hey, this is really beneficial for this compared to a syndicate. So a syndicate is a legal structure that's set up to be able to raise money from individuals and other businesses, entities, whatnot, for a single deal. So somebody will put somebody, let's say, finds an apartment complex, they're looking to raise money for it. They can pay to have a syndicate formed, and now they're legally raising money to purchase that one asset, compared to a fund can be closed-ended, open-ended, that we can talk a bit more in a minute. But a fund, you're investing money into more or less a company, an individual. You're not giving them money. Again, it's a structure that's set up, but you're investing in multiple deals. So a fund is going out and raising money, and you're investing in the fund, and then that fund will take the money and will go out and find avenues to invest in, like multifamily, self-storage, things like that. So at a very high level, we'll break down some more differences between them, but at a very high level, that's a difference between a fund and a syndicate. So I guess one thing to start off with talking about the differences would be capital requirements between investing in a fund versus investing in a syndicate, if you want to chat about that.
yeah, and we're going to talk about maybe different scenarios of why you might have a syndicate or a fund. They both have their own scenarios, I would say. We'll communicate why we chose a fund for cherry pick capital, for instance. So capital requirements was one of those pieces. So within a syndicate, you pull together some outside investors. It's a single deal. Oftentimes the capital requirements are much higher because it's a single deal that you're going after together. And so each individual needs to contribute a larger amount. With a fund model, usually you can see a lower minimum investment requirement, because you oftentimes will have more investors. So more investors, lower capital requirement. And when we were looking at it, for us, why we chose a fund for cherry pick capital was the idea that we knew friends, family, we wanted to give them access to the deals, didn't necessarily want to say, hey, we're going to need $50K as minimum investment. We knew people that were going to be maybe on $15K or $20K sort of style, and wanted to allow them access to the deals that we're pursuing as well. So that one was a big one for us, and also communicating with a larger group, allowing us to talk to more investors, get more people involved in the fund, and have a lower barrier of entry. The other piece is asset ownership. So maybe touch on that one.
Yeah, so with a syndicate, you own a part of the entity that's set up to purchase that one property. And again, with a syndicate, you're only pursuing that one property, and that's it. Once you purchase it, then that syndicate is kind of done with. It's still set up while you're managing the property and whatnot, but if you want to go out and pursue another property, you'd have to set up another syndicate for another property. To where a fund, you actually own shares within the fund itself. And again, you can have an open-ended fund where the fund will continue in perpetuity, or you can have a closed-ended fund saying, hey, this fund's going to be around for 7, 8, 10 years, whatever it is. We're going to raise money for the first 2 or 3 years, and then after that, we're going to close off this fund in regards to accepting additional money, and then the fund will continue to operate the assets that it buys, and it will continue to buy assets up until that 7, 8, 9, 10 year mark, whatever that is. So with the fund, there's definitely more ability to have diversified investments, which was another attraction for us was, hey, instead of setting up a syndicate and just going after this one asset and having to set up another one and go after this asset, we had investors that wanted to kind of invest in us. And they knew that we could go out, we could find deals, and we could find cash flowing deals and whatnot. So for us with the fund, we were able to pool monies together and been able to purchase apartments with it, self-storage with it, things like that, which helps diversify our portfolio. So if, let's say, multifamily sector takes a bit of a hit for whatever reason, we do have other asset classes of, let's say, self-storage that could potentially help offset that. So that was a major attraction for us when we first set it up.
Yeah, absolutely. So you have that diversification across those different asset classes. We're picking up a self-storage facility now. We have multifamily in the fund today, along with private money lending. So on single family. So you look at that, the diversification across those different asset classes adds a lot of value. And then diversification across different markets as well. So we have multifamily property in a small town called Fort Madison, Iowa. That's done really well for us. Cash flows really well. And now we're picking up self-storage in Council Bluffs, Iowa. And we've done private money lending for single family in Omaha, Nebraska. So kind of all the different asset classes allows you to have more protection, downside protection, along with some upside opportunity as well. So that diversification kind of plays a good role from opportunity for appreciation along with downside protection.
Yeah. And with both a fund and a syndicate, it's often passive investing for somebody to invest in either one of those. You're not the one that's going out there and sourcing the deals, funding the deals, managing the deals. So a big reason for us to set up a fund, but could be a syndicate too, was, like I said, we did have a lot of family friends that wanted to get involved in real estate but had full-time jobs. They just liked the appeal of real estate and the potential returns. So with both, they're definitely passive, and people like our investors are looking for guys like us that can go out and be able to source deals. So if you want to chat a little bit about our access to deals compared to maybe what an average individual may come across.